Two companies do almost exactly the same thing. They rent out the computing power that runs artificial intelligence. They're even worth about the same, roughly $43 billion each. One of them has crashed nearly 50% this year. The other is up 230%. This is the one that's winning. Meet Nebius. It's the fastest-growing cloud company on the market. It's backed by Nvidia, and it just signed a $27 billion deal with Meta. So the question is Nebius the smartest way to own the AI boom, the one that actually works, or a bubble priced to perfection? The answer comes down to one number. Stick around, because part 3 is where most people get Nebius wrong. Nebius is a $43 billion company, and its revenue is exploding. We'll run this in 3 parts: the bull case, the catch hiding underneath it, and the chart, then a verdict, and the one metric that settles it. Let's start with why this stock has tripled. 1. The growth is frankly absurd. Last quarter, revenue grew 684% year over year to about $400 million. That is not a typo. Management is guiding for $3 to $3.5 billion this year and a run rate of $7 to $9 billion by the time the year ends. 2. The backers and the backlog. Nebius has around $46 billion in contracted revenue, including a $27 billion multi-year deal with Meta. And Nvidia, the most important company in AI, put $2 billion of its own money into Nebius. When Nvidia invests in you, the market pays attention. 3, and this is the one that separates Nebius from the pack. It's healthy. While its biggest rival is buried under debt and burning cash, Nebius has positive operating cash flow, expanding margins, and a far stronger balance sheet. It's growing faster and it's funded better. The fastest growth, the best backers, and the healthiest balance sheet in the entire neo-cloud space. So what could possibly be the catch? The catch is the price. You have to pay up a lot for all of this. Nebius trades at around 13 times its sales. To put that in perspective, a typical software company trades at a small fraction of that. And this is a stock sitting near its highs, after tripling. In other words, an enormous amount of future success is already baked into the price. And here's why that matters. Nebius is still small and unproven at giant scale. To justify this valuation, it has to execute a massive, expensive build-out almost flawlessly for years in a brutally competitive market against its rival CoreWeave and against the trillion-dollar giants, Amazon, Microsoft, and Google. It also depends completely on 2 things staying true: Nvidia continuing to supply the chips and the AI spending boom continuing at full speed. If either one wobbles, a stock priced for perfection has a very long way to fall. And this one already swings 20% in a matter of days. So here's the scorecard. On one side, 600% growth, a $46 billion backlog, Nvidia's backing, and a healthy balance sheet. On the other, 13 times sales, a sky-high bar to clear, fierce competition, and total dependence on the AI boom. The best in class, or priced for perfection. For a tiebreaker, we go to the chart. Fundamentals tell you what, technicals tell you when. And Nebius's chart tells a story of a monster run, taking a breather. Over the past year, the stock is up around 230%, and it hit a high near $276 before pulling back to around $208. Here's the key. The long-term trend is still clearly up. The stock sits well above its 200-day average, near $149. That's the floor that matters. But short-term, it's cooled off, slipping below its 20- and 50-day averages, both up in the low 200s. Momentum has cooled with it. The relative strength index has dropped to around 35, approaching oversold, a sign the recent pullback has been sharp. The levels that matter. On the downside, watch the pivot around $178, and below that, the 200-day average near $149. As long as it holds those, the uptrend is intact. Overhead, the stock needs to reclaim its 20-day average, up around $219, to prove the pullback is over, and then the old high near 276. So the chart says a powerful uptrend, taking a healthy breather, and now testing whether the buyers come back. So best in class or priced to perfection. Here's the honest framework. The bull case is real, and it's strong. Of all the pure AI cloud bets, Nebius may be the best positioned, the fastest grower, with the best backer and the healthiest balance sheet. If the AI build-out keeps going, this is a company built to win it. But the bear case is just as real, and it's simple. At 13 times sales near its highs, the market is already assuming Nebius wins. There's very little room for error, and a growth stock priced for perfection is punished brutally the first time it disappoints. Which brings us to the one metric that settles the entire debate: the revenue run rate. Management has promised $7 to $9 billion by the end of the year. Watch that number every quarter. If Nebius keeps hitting these staggering growth targets while keeping its balance sheet healthy, then it grows into that valuation and the bulls are right. But the first quarter it misses, or the first sign the cash is running dry the way its rivals did, that 13 times sales price will not hold. Pair continued monster growth with a reclaim of that $219 level, and the believers have their proof. Until then, Nebius is the highest quality bet in the AI cloud boom, and the one with the least room for a mistake. A stock to understand completely before you ever touch it. That's the full breakdown, the growth, the backers, the valuation, and the why behind all of it. If this helped Nebius make sense, subscribe. Every week we break down one company on Wall Street exactly like this, so you can invest with a framework instead of a feeling. The free breakdown sheet, with all the numbers, is linked in the description. Quick but important. This channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.